Let me paint you a picture. It's a Tuesday evening. You're scrolling through your phone, maybe Reddit, maybe Twitter, maybe just a financial news app you downloaded 6 months ago and check more than you'd like to admit. And you see it, some stock, some fund, some asset that's up 34% this year, and something inside you just chips, not panic exactly, more like this quiet creeping feeling that you're standing still while everyone else is moving. You look at your own portfolio, steady, boring, doing what it's supposed to do. But suddenly, boring doesn't feel like a strategy, it feels like a mistake, so you start reading, then researching, then convincing yourself this is different, this one makes sense. And before long, you've made a move you didn't plan on making. I've been there, a lot of people have. And here's the thing, it almost never ends the way we picture it in that Tuesday evening moment. Today I want to talk about why that happens, and more importantly, what's actually going on in your brain when it does. Most conversations about investing mistakes focus on the wrong thing. They say, you need more discipline. They say, stop being emotional, as if the problem is a character flaw, like if you just tried a little harder or cared a little more, you'd magically stop making decisions that hurt your returns. But that framing misses something important. These aren't just bad decisions. They're predictable decisions. They're the decisions that humans, wired the way we are, will almost always make under certain conditions. And understanding that change is everything, chasing yield, meaning the habit of constantly moving toward whatever is performing best right now, isn't greed. It's not stupidity. It's your brain doing exactly what it was built to do, detect where reward is happening and move toward it. That instinct kept our ancestors alive. In a modern financial market, it tends to quietly erode returns over a decade. There's a concept in behavioral economics called performance chasing, and the data on it is pretty sobering. Study after study shows that when individual investors, people like us, are given the freedom to move money around, we consistently buy high and sell low, not on purpose, not because we're reckless, but because the natural human response to seeing something go up is to want it, and the natural response to seeing something go down is to distance yourself from it. Think about what that looks like in practice. A fund has a great free year run. It gets written up everywhere. Your friend mentions it. You notice it in your app. And by the time you buy in, genuinely convinced this is a smart decision, the period of exceptional returns is often already over. The money that was made, it was made by people who were there before it became obvious. There's a famous term for this in investing circles, the behavior gap. It was coined by a financial planner named Carl Richards, and the idea is simple. There's what an investment actually returns over time, and then there's what the average investor in that investment actually earns. And those two numbers are almost never the same. The investor number is almost always lower. Because we get in late. We get out early. We get spooked. We get excited. And here's where psychology really starts to complicate things. Our brains process financial loss and financial gain in a deeply asymmetrical way. Losing $100 doesn't feel the same as gaining $100. The loss feels approximately twice as painful as the gain feels good. This is what researchers call loss aversion, and it has a massive impact on how we manage our money. When a portfolio dips, even temporarily, even as part of completely normal market behavior, the discomfort we feel often pushes us toward action. We sell, we shift, we do something. Because doing nothing when something feels wrong runs counter to every instinct we have. But in investing, activity is often the enemy of outcome. The investor who checks their portfolio once a quarter tends to make fewer reactive decisions than the investor who checks it every day, not because they're smarter, just because they're exposed to fewer moments of discomfort that trigger a response. There's also something worth naming called recency bias. We tend to weight recent experiences far more heavily than older ones when we're predicting the future. If the last 6 months have been rough, our gut tells us the next 6 will be too. If the last year has been exceptional, we expect more of the same. Markets don't really work that way, but our pattern recognition doesn't know that. Here's the mindset shift that I think actually helps. What if you stopped thinking of your portfolio as a scoreboard you're trying to win right now, and started thinking of it as a slow, quiet process you're trying to protect from yourself? That sounds a little strange, I know. But the best long-term investors, not the flashiest, not the ones with the best hot takes online, tend to be the ones who build systems specifically designed to reduce the number of decisions they make. Automatic contributions, predetermined asset allocations, long rebalancing windows. Not because they're passive or disengaged, but because they understand that their own judgment, in the heat of a market moment, is one of the biggest risks they're managing. Your returns over 20 years will be shaped less by which funds you picked and more by whether you stayed in them when staying was uncomfortable. So what does this actually look like in practice? One of the most effective things you can do is create a simple investment policy statement for yourself, even just a paragraph or two written down somewhere, that describes why you're invested the way you are and what would actually need to change for you to make a shift. Not the market dropped, or something else looks better right now. A real structural reason. Having that written down before you're in a heightened emotional state gives you something to check your impulses against. Another thing that helps is reducing your exposure to financial noise. That doesn't mean being uninformed. It means recognizing that most financial media is optimized for engagement, not for helping you make good long-term decisions. A lot of it is designed to make you feel like something is always happening that requires your attention. Most of the time, it doesn't. And if you find yourself seriously considering a change, give it a week, not because a week will give you more information, but because a week will give you more distance from whatever emotional trigger fired the impulse in the first place. Here's what I want you to take away from this. The markets are complicated, yes. But a lot of the damage that happens to long-term portfolios isn't caused by market complexity. It's caused by very human, very understandable responses to discomfort, excitement, and the fear of being left behind. You're not broken for feeling those things. You're not undisciplined for having those impulses. You're just human, and the goal isn't to stop feeling them, it's to build a little space between feeling them and acting on them. The most boring portfolio strategy that you actually stick to will almost always outperform the most exciting one that you keep second-guessing. That's not settling. That's actually winning. Progress, not perfection. That's all this has ever been about.